9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching The China Show. I'm Yvonne Man with David Ingles.
Good Friday morning from the Asia Pacific. Counting down to the open of markets in Greater China. Our top stories today: stocks across the Asia Pacific trading flat, cautiously sideways. Investors bracing for the U.S. jobs report and a possible Supreme Court ruling on Trump's tariffs. Oil extending gains with Iran and Venezuela in focus.
Bloomberg learns that China plans to approve imports of Nvidia's H200 chips as soon as this quarter, renewing access to a critical AI market.
Speaking of AI, another Chinese startup is set to debut in Hong Kong this hour. We'll be speaking exclusively to MiniMax co-founder and COO Yeyi.
And Rio Tinto shares slide as talks resume with Glencore on combining to form the world's biggest miner.
Good Friday morning. Again, thank you for joining us. Lots to get through as we wrap up the first full trading week of the year. And as you can see, it's a quiet bookend to, well, the night is young. Full trading day ahead. But so far, things look quiet on the price front. We can talk about turnover in a moment because things have certainly picked up substantially in China. You're getting a lot of bullish calls coming through Goldman, Morgan Stanley, more on that in a moment. U.S. futures, as you can see, flat, as with the regional benchmark. We'll be looking at, of course, inflation numbers coming through. That's for December in about 28 minutes or so. I'll pull back across some of the big tech winners this week. Nikkei's up, though. In fact, flip the page here. See, we talked about TSMC and Samsung very much in focus this entire week. And as you can see, a pullback in both. Rio Tinto, of course, is the other big story. Still is, in terms of points and percentage, last I checked. The biggest drag in the benchmark today on the back of this restarting of merger talks with Glencore. Yvonne mentioned that at the top of the show. Also want to mention separately this rally in defense-related names. Hanwha Systems, one of them, 13% in Korea, is another theme that's emerged this week because of this geopolitical premium that's, I want to say suddenly baked in, but suddenly we're talking about it at length. Right, the currency markets, this is a big could. You have the Supreme Court, U.S. Supreme Court on Friday. They could rule, and I say they could rule because it could be it could be part of the decisions they lay out. We don't know, of course, but suffice to say this possibly is consequential globally if indeed the Supreme Court rules along the lines that the lower courts have in terms of saying, nope, that specific group of tariffs, that's not legal, and you might have to get that back, or you can't reinstate that, or you can't continue doing it. Anyway, we'll have more on that in a moment. U.S. dollar, Japanese yen. Okay, let's whole name the pair. Why not? Okay, Brent crude, massive pop yesterday. Short squeeze, question mark, extending those gains today. We're stable across precious metals. Bottom of the screen is copper. And, of course, the approach to the open today. A50 futures doing this. Shanghai crude should see a pop. There we go. Yep, 1.6%. Dollar China flat going into the open today.
Yeah, in fact, dollar China, you just got that call from Morgan Stanley. They're expecting 685 for renminbi by the first quarter there. So expecting still some appreciation for renminbi, and really changing their forecast from a 7 handle north of that before. So certainly that's one thing to watch. Of course, that renminbi strength still remains to be a key theme here. CPI data, as we mentioned there. Tech, metals, energy are the sectors to watch. Given some of the news that Dave just highlighted there. There is a CGB sale. In terms of the global front, though, Dave, I think there's a lot of key things. The jobs report, that certainly is one thing on the whole Fed discussion. This oil meeting and the who's are going to be attending a meeting with the Trump administration on Venezuela on Friday. And then, as you mentioned, that potential Supreme Court tariff ruling that could come as early as today. I'll start with the oil meeting because there seems to be still a gap about what the vision that the Trump administration wants, about how much they can drill, how much access they get, who they can sell it to. And really how, I guess, aggressive these oil companies want to be.
Well, they're paying for it.
Well, they have to.
Well, yeah, on paper.
And I think a lot of them want to at least see some stability in the government first before they can actually put, millions upon millions of dollars in investment into repairing all these rigs and the like. So.
Which could be a multi-decade exercise, right? So
even after Trump's terms, right?
Yes.
So
yes, and how much degree of confidence can you put in something that certainly moves beyond decades? But yeah, the point I think is, for the vision to come into fruition, right?
Yeah.
He will need the support of the private sector. And I think it's almost similar to, remember a few months ago when we had the big tech CEOs at the White House and he talked about we need to do something about a semiconductor conversation here.
Yeah.
And it's similar with the energy market. And you kind of have to think, right? So it's the two concepts that we're talking about today, whether that's a Supreme Court ruling, possible ruling on tariffs. If you think about it, that's a grab of other people's revenues, right? In terms of EMs, and they might want some of that back if in favor of the Supreme Court. And it's also an oil grab if you think about it too, in terms of just securitizing that asset in terms of national security. But yeah, it's very deep conversation, longer term, and of course short term is the jobs report, which we'll figure out. And of course, even Myron talked about, we're going to need, there's 1 million Americans without jobs, which we could get into the job market without causing inflation, I think is the point he was making there around the Fed conversation.
I mean, that's still going to be continuing on, and whether, this weakening jobs market is going to be the key focus in this whole Fed mandate. And of course, when it comes to Nvidia, right? I mean, the fact that it seems like Beijing has given the green light, according to our sources, that some companies can start getting access to these H200 chips. You gotta wonder what the Alibabas, what the Tencents will do, right? Will they still lean towards maybe getting some of these orders into Nvidia, or are they going to go local as well?
Yeah. Well, they have two options now. I guess and I think that it came out right before the close in Hong Kong yesterday. Markets already reacted, and I think we talked about how we are looking at the tech rally as one of the areas of focus today within the Chinese markets as something that could continue. In fact, if you look at what happened overnight, the Golden Dragon Index, you had really big gains there on the back of the tech story. The other thing I want to mention too is Morgan Stanley actually came out. They're quite busy, Laura Wang and her team, right?
Yeah.
And they're saying we've seen a really noticeable pickup in sentiment in China. So you have liquidity and turnover has really picked up substantially. In fact, I think the daily average has been north of 2.5 trillion yuan for the first 4 days of this year. So just something to watch going into this final session of the week here.
They're at least constructive for like 6 to 12 months for Chinese stocks as well. And the key focus is, of course, the pipeline that we've seen when it comes to IPOs in Hong Kong. And we're about to see another one, MiniMax. Another one of China's largest generative AI startups is set to begin trading in Hong Kong today after an IPO that raised $619 million. Let's bring in Stephen Ingle. He joins us now with the latest, and he joins us live, I believe, from the Hong Kong Exchange. Steve, how are things looking today?
Yeah, it's getting noisy here. Obviously, there are several debutantes in addition to MiniMax, 3 in total. But MiniMax garnering a lot of the attention because it's really the survivor of what was a brutal price war among those generative AI, lower cost, lower capital, and open source players in China. And again, that's the big question going forward for a company like MiniMax, which is a generative AI play in China that is similar in some respects to OpenAI's Sora, which is text to video model. And actually, MiniMax is a has multimodal capabilities that started in audio and in video, and then eventually evolved to their large language model M2. But that's maybe where the comparisons with OpenAI and Sora end, because they are a lower capital company. They have fewer chips. They have leaner headcounts than all that money that has been put at generative AI in the United States, like Anthropic, like OpenAI and the bunch. So I guess today's listing is a bit of a litmus test to see investors' appetite and belief that the open source lower capital model, sort of the no frills approach to generative AI, has legs, and who will survive after what has already been a brutal price war. So those are the questions we'll put towards the co-founder and COO in about an hour's time.
All right, we'll find out. Steve, fantastic. Stephen Engel there on the ground for us at the exchange. 3 trading debuts today, one of which, as you were pointing out, of course, is MiniMax, which ticks all the right buzzword boxes there. The other top story we're tracking, as Yvonne and I just talked about there, is the H200 chip out of Nvidia, and China is said to be planning to approve some imports of the stuff as soon as this current quarter. Let's bring in Edwin Chan, our Asia Tech Managing Editor, to tell us about what we know exactly about what's going to be allowed and the timing of this.
Yeah, I think that's the key. In terms of the timing, we're a little firmer on that. We think it's going to happen soon as this quarter. So we're talking about in coming months, most likely.
Yep.
Where it starts to get a little uncertain is the extent to which China will allow H200s into the country. So our sources are telling us that it's going to be excluded from sensitive networks, obviously, but also what they refer to as critical infrastructure. And when it comes to that term, the definition can be a bit loose. I think it depends very much on how, say, the Commerce Ministry or various agencies choose to define it. So the key thing to know here is that it's not going to be a free-for-all. Nvidia will not have carte blanche to sell H200s. That it's going to be a very carefully vetted process, and it's likely to be, at least initially, to a limited extent only.
Why do you think there's a change, it seems, from Beijing on this? I mean, at first it was all about, we can do it alone. I'm going to push for, our homegrown tech giants to kind of do it by themselves and self-sufficiency. What do you think sparked this sort of slight change?
Probably two key factors. One is the fundamental demand. I think the world cannot get enough of AI accelerators. Now, the H200 is technically a generation behind, or actually 2 generations behind, the best and the brightest AI chips out there, which will be the Nvidia Rubin. But it is still immensely powerful for AI inferencing. And there's not enough of these inferencing chips on the market. The domestic producers cannot get the capacity and production up to the point where they will satisfy local demand. So there's that. And then also, I think Beijing realizes that AI is a frontier that they must be competitive in, if not win. Quite simply, they need to surpass the US in what's going to be a defining modern era technology. So I think there is that impetus as well.
Edwin, thank you. Edwin Chen there and their team with that scoop when it comes to Nvidia, but certainly could be a pretty big potential win for the company, that access to the Chinese market once again. And stay with us as we speak with the co-founder and COO of MiniMax, Yeyi. That interview live from the Hong Kong Exchange. She's going to be speaking with Steve at 10 a.m. Hong Kong time. You're watching The China Show.
Right, we're looking at futures pointing to a slightly higher open. We're also just getting the fix of the day out. 701.28 against the U.S. dollar relative to estimates of 683. You do the math, that's about the spread between the two. Certainly the FX conversation today really points to the U.S. with everything from the jobs report, a potential ruling from the U.S. Supreme Court on tariffs. I think we can get to all of that a bit later on. But yes, that's just the other side of the yuan conversation.
Yeah, potentially $150 billion of tariffs that could be canceled if, in fact, the Supreme Court rules against these Trump tariffs. So that certainly is a lot at stake for more than 1,000 companies that have already filed for lawsuits on that front. So certainly that's the one thing to watch in the next few days, or a few hours. Let's bring in Joshua Crabb, head of Asia Pacific Equities at Robeco. He joins us here in our studios. Joshua, Happy New Year.
Happy New Year.
I think it's one of the few years that we've actually have seen Asia equities outperform the U.S. for 2025. Are we likely to replicate that sort of success this year? Why?
I think so. I think it's pretty simple. We've been waiting a long time for this, right? It's been a decade, basically a decade. I think what's happened is, all these asset allocators are going to be sitting down beginning of this year saying, okay, what's happened? We've had Asia outperform. Is it going to happen again? And then they're going to look at valuations, and the valuation gaps are pretty big, number one. Number two, people are not heavily weighted in it. Number three, there's a lot of cash sitting on the sidelines, and economic activity is starting to increase, arguably from low levels, outside of the US for the first time. So I think we're set up for this to continue, for that valuation gap to continue to close.
And just in terms of specific markets in Asia, you talked about a valuation gap, right? And that also varies between the different markets. Where do I take advantage of that the most?
Think? I mean, look, the obvious one that's sitting out there is Southeast Asia. The problem with Southeast Asia is a few issues sitting over it. But
there's no AI there too, though.
There's not, but there wasn't a lot of AI in what people saw at Korea at the end of last year, or people weren't thinking about that in China at the end of last year, or and so I think there's a lot of these things sort of that are sort of sitting out there. But for me, again, I think that lesson of Korea last year, I think it was up 97% last year.
Crazy.
And at this, the beginning of last year, we're sitting there talking about political upheaval. We're talking about, things are not looking really, really good. And that was the surprise market. So I think, Southeast Asia is the one to just keep your eye on at that sort of margin. It's very cheap. It's literally never been cheaper. And it's got great long-term prospects. So I think that's, one to really just keep in your back pocket for this year.
Is there still a need to allocate to North Asia, though, just given what you've seen in Korea? Because it seems like this tech... Is it going to be more driven by tech leadership than any sort of reflation cycle, you think?
Yeah, I think what's been interesting if we sort of look at what's happened, if we go back to the end of last year, it's like, well, AI is only a US story, right?
Yeah.
That's the only stories around the US, and what we've seen is people start going, well, actually, you need some HBM, right? Or maybe some other companies can benefit from this, or maybe some other companies can take some advantage out of that. And we've seen that, helping in Korea, we've seen that helping in China, which were disliked last year as well. So I think that will sort of continue to happen, and people are going to start looking for other areas, right? Are there other parts where they can benefit from this? And that may be in some of the industrial supply chain. For example, it might be in things like with the packaging technology changing. Maybe things like heat sinks as the heat power is starting to pick up. So I think there are still opportunities, but not quite as obvious as it was.
I mean, anecdotally, I'm not sure how much more underweight still are global investors at this part of the world after a year, obviously, that we've had last year, and I wonder how much room, to the earlier point you're making, that has to squeeze even further.
Yeah, I think it's always hard to get a real honest answer to that because, a lot of them are surveys. And surveys often tell you what people want to have been rather than what they actually are. But if we look at the flow data, and again, if I look at what anecdotally we're seeing, over the last sort of 6 months or so, you're starting to see it creep in slowly.
Okay.
And I think that's what sort of happened because, people feel like they may have missed out a little bit, then people sort of chase a little bit. But I really think that when you think about those really large pools of money, whether it's sovereign wealth funds, insurance companies or whatever else, they tend to really look at this at the start of each year. And I think that is something that, we will start to see sort of flow back into it. And we are seeing more interest. We're seeing more people asking questions around Asian markets, as I said, for the first time, I can remember in almost 10 years.
Right. Yeah, you mentioned about the valuation. Is it the fact that Asia is actually catching up to the U.S., or is U.S. normalizing to Asia?
Yeah. I think this is going to be the really important question over the course of this year, right? So the U.S. is pretty fully valued, right? We think that's sort of okay. There's still money on the sideline. Earnings are still reasonably good. There's still fiscal stimulus coming at the margin. But if we look at Asia, it's gone from being very, very cheap, particularly certain markets like Korea and China, to being not quite as cheap, but still reasonably cheap. So then the big question is like these gaps tend to change. So do we see a big correction in the U.S. or do we see Asia continue to move up? And again, this comes back to when we sort of look at money sitting on the sidelines. We look at the earnings revisions starting to pick up. They're actually starting to pick up to sort of better levels, and we think that allocation needs to sort of switch. So we think you see more of a catch up in these other markets. Again, now that may happen quickly. That can sometimes happen in a couple of quarters, in which case the second half of the year may be tougher because that valuation support will not be there. And that's where you just really need to keep an eye on these markets.
What's the macro overlay? What happens if the Fed cuts more than consensus? Let's call it 2 cuts now. Is that a pro-U.S. tilt? Does that help all boats?
Yeah, I think it'll help all boats. And I think what the reality is, it'll stop any risk of a U.S. correction, right? And then I think, again, people are going to start thinking, okay, where do I make my money? And if we look back, say, to 2000 when we saw that big move up in the U.S., right? End of Asian financial crisis, no one likes Asia. The U.S. is taking the lead in mobile phones, taking areas in these sort of areas. And then people started to think, well, actually, there's these other companies in Asia that are really cheap. In telco, in media, you saw that big catch-up start to happen before you saw the sell-off. And it sort of feels like that in that sort of environment at the moment.
If you talk about valuations, and you mentioned Southeast Asia, where does India fit the South Asia story? Because they were clearly a laggard last year.
Yeah.
Is this going to be a re-rating in India this year, given, domestically it seems like there's some growth drivers there now? Yeah,
so for us at the end of last year, India was pretty expensive. Over the last couple of years, seen a lot of money move from China into India. People got very, very exuberant. The valuation premium to other emerging markets hit an all-time high. So to us, that looks stretched. Now, over the course of last year, you've seen not just that come down, but you've seen the likes of Korea and China come up. So that gap has closed a bit. It's still not a standout cheap market, unlike Southeast Asia. But it's got to a point where it's reasonable, right? So you should be looking for stocks in that sort of market. And we've seen a couple of other things happen as well. The GST cuts, we've seen a few moves to try and stimulate that economy. So I think it's one to look for it, but more at a stock level rather than just saying, hey, this market's going to be a strong performer. Whereas getting back to Southeast Asia, if we do see something happen there at a macro level, people are going to start going, wow, this is super cheap. And again, we saw what happened in South Korea last year.
Southeast Asia in particular? Are you
well, Indonesia is the big market that people like to look at, but even the likes of Philippines. And I think one of the other surprise markets last year we don't talk a lot about because it's frontier was Vietnam, because that was seen as a very similar scenario. It was considered people had their concerns around tariffs. We actually saw pretty good performance last year, despite all those macro concerns. And we think those type of markets continue to do well. Their long-term prospects are a lot better because lower GDP per capita, better demographics than some of the other Southeast Asian countries.
Joshua, Happy New Year. Have a good one, sir. Let's do this again. Joshua Crabb there, head of Asia Pacific Equities, bullish case for equity markets in 2026 there out of Robeco. MiniMax, we're up 43% in the early goings. There we go. We'll have more, of course, on this is one of the three debuting here today here in Hong Kong. Hang Seng Index coming up on your screens. We have I think it's a 9 or 10-year bond auction today. 2035 bonds, to be more specific, I believe, there in China today. So watch that closely. This is the China Show.
Live pictures out of Hong Kong Exchange. Of course, MiniMax, that debut looking pretty good here right now. We're up 42%. Of course, it's just one of three, as we mentioned, with Suzhou Rebo Life Science. That is, of course, a biotech company. And then Yunnan Jishun Resources. They're a miner. So, yeah, all the kind of hot sectors are all kind of seeing a flavor of that doing quite well with these companies here today. So there you go. Double-digit gains for all three here. But certainly for MiniMax, that's going to be a key one to watch because it almost is a test to see whether there is more investor enthusiasm in the software side of things when it comes to AI.
Yeah, I mean, certainly there's been a rotation into the hardware and semis equipments, right? So it's really a test. And not just today, right? So we'll see how this actually trades over the next few weeks or so. It's mostly been a fantastic first day. I got to say, though, over the coming weeks, most have actually come off those highs, but this is, of course, a very long-term story more than anything else. So we'll get to that in a moment. Also coming up in the next few minutes or so is December inflation numbers coming through, so watch it very, very closely. We are expecting a pickup, perhaps food prices. So we'll unpack this story for you once the numbers break, including the opening bell and, of course, the trading debuts here in Hong Kong. Happy Friday. The Open is next. This is the China Show. Welcome back. Another day, another set of Chinese tech companies hitting the markets, raising money. We're 30 seconds to the opening bell, and of course the banging of the three gongs on your screens. Our man on the ground, Stephen Engel, is there for us live. Steve.
So obviously we're waiting for the gong for the debutante here in Hong Kong of MiniMax, one of China's largest generative AI startups, seen as a challenger, a lower capital challenger to the likes of OpenAI and Anthropic. Let's hear the countdown to the gong here in Hong Kong.
3, 2, 5, 4, 3, 2, 1, 枪！ 祝贺 MiniMax 瑞国生物和基因资源在香港交易所成功上市。来，我们请舞台上的各位嘉宾，我们一起来到。
Obviously, we have the gong here. We have the open of trade for one of China's largest generative AI startups. That is MiniMax. Coming up in the next half hour, we'll have the co-founder as well as the COO coming up and talking to us about the plans going forward. Where are they going to spend those proceeds from this $619 million IPO? Again, the generative AI space in China is an open source, lower capital, fewer chips environment, lower, leaner headcount. Can they compete on a global stage with the likes of OpenAI, Anthropic, and others, which of course have a much higher capital base? And there, just like in the US, there are questions about the amount that is being spent in China as well on the infrastructure. When will these generative AI players be profitable and have reliable revenue streams to essentially justify what it could be some lofty valuations, as the debutante here, MiniMax, up 37% in the opening minutes of trade here in the Hong Kong Stock Exchange. Going to send it back to you. Stay tuned in the next half hour where we'll have the co-founder and COO.
Yeah, look forward to that interview here, and certainly it seems like so far pretty good debut for MiniMax. And after what we saw with their rival Zhipu this week, was a bit more of a lackluster debut for that company. So we'll see. Can this whole AI trade extend more into the software side of things? That certainly is going to be the key question for the market here today. Also, another question about inflation, whether we see it or not in China. Those numbers just coming through here. CPI aligned with estimates, 0.9% year on year in terms of price increases there. PPI prices once again falling 1.9%, just slightly better than estimated there. But yeah, same story still seems to be, Dave.
Yeah, and I think that the broader outlook on PPI, let me start with that, is that the low base effect will start to show up. And I think also keep in mind, right, we have underlying metrics like you have commodity prices, most in the basket have started to pick up, so that's starting to show up in some of the PPI numbers or some of the forward-looking underlying price surveys like the PMI, for example. And at some point this year, I think it's mid this year, BE thinks will actually we might turn positive on that, might turn positive. CPI, that's still an open question, but that has to more to do with demand side and also a lot of the efforts we've seen this year only, right? So battery operators, online platforms, to curb excessive price competition and how that sort of plays out. And
there was just a line recently from even just the auto sector where despite what regulators are saying, they're defying what is being told about, really anti-involution, and they're still cutting prices at the start of the year. So that certainly is one thing to watch still within some of these sectors there that are feeling those price wars. You take a look when it comes to the open of markets, and it's slow going, but we're still seeing some decent gains when it comes to Hang Seng. HS Tech is up about 31%.
Baba's up 4%.
Baba's up 4% here. It's interesting because you have the likes of Morgan Stanley's Laura Wang, her team basically have said, things are looking pretty constructive in the next 6 to 12 months for Chinese stocks. The sentiment seems to be much more positive. If you take a look at liquidity, when you take a look at the optimism around AI and the like here, so notably improved, they say, when it comes to the positive vibes.
In the A-share market,
Yes.
So let me just read that quote because, in fact, their team just dropped that in our inbox, as you could check, actually, the email, it just fell. So market sentiment rose notably in higher turnover entering 2026. Stronger currency, to Yvonne's point, ample liquidity, constructive on China over the next 6 to 12 months. You have liquidity support, you have ongoing tech advancement, and a broad set of thematic opportunities within this great Chinese market. In fact, just on the chips, right? That's coming up on your screens as well. This is also in the Nvidia story, too.
Yeah, so the fact that, according to our sources, that Beijing has now allowed for some sectors, some companies to access these Nvidia H200 chips. And the timeline is interesting as well, as soon as this quarter. So we're already hearing that there might be some interest in the likes of Alibaba and in some of these pre-orders for those chips as well. So that certainly could be negative for, of course, these domestic names like SMIC, Huahong Semi. You are seeing that negative reaction across Capricorn Tech here as well this morning. Oil stocks, we talk about that bump up in prices that we saw overnight here. Is that a short squeeze? Certainly, but that is benefiting some of these oil names like Sinopec, PetroChina. But, you add some of the tensions that we're seeing in Iran. It's not just a Venezuela story, Dave. So there are still, maybe a need to kind of add a bit more of that geopolitical premium on oil.
Yeah, the floor is more solid now, despite the separate narrative that we're going to get more oil in the market, that the premium is going to push prices even further higher. And certainly that takes us really nicely into the CPI conversation and PPI, because there is a broader commodities component there when it comes to PPI. And it's not just oil, right? You have this week, it's copper, it's zinc, obviously precious metals and everything else. Let's bring in Dan Wang out of Singapore, China Director at the Eurasia Group, all things economics, macroeconomics, and perhaps even geopolitics. Dan, Happy New Year to you, and thank you for joining us. Why don't we get started with just your broad take? So the CPI print just now, in line with estimates. Market is wondering, though, what happens to that number this year. Where do you think inflation goes this year?
Well, if we're talking about PPI, it might go up, especially because it's the first year of the 15th five-year plan. There's a high commitment of a number of new projects, especially in the manufacturing sector, so the demand is high. But when it comes to CPI, we have to keep in mind that CPI ultimately is still a monetary phenomenon, and the central bank is still quite unwilling to cut interest rates. Their goal is still very much to the long term, supporting of the high-tech sector and modern industrial chain. So I don't see the possibility of the short-term reverse, actually, for the inflation trend.
Okay. In terms of the outlook then for growth in China this year, do you think that they can still aim for that 5% growth target? How easy of a target is that going to be reached for 2026? Because it seemed to be pretty easy last year.
Last year was actually very difficult. We can't forget how difficult it was for China in Q2 and Q3 under the pressure of the tariffs. But then export has been outperforming almost every single month. And this year, I believe the GDP target will have to once again be about 5%, if not higher. One big reason is that the export sector has been consistently underestimated in the past couple of years. And with more Chinese companies going global, they're going to import way more than before, including the Chinese machinery, raw materials, industrial inputs, technology, labor, technical assistance. So that will be all counted for as the export for China this year. And I'm actually quite optimistic.
Can I ask you about the currency? We've been on a strengthening trend over the last, 7, maybe 8 weeks. And is there an implicit, stronger currency policy, you think? What's changed? Has anything changed? It's my question.
Based on the broader discussion within the policy circle, it seems that the dominant tone is still on the stability of the currency. The recent revaluation of yuan is mostly backed by this passive decline of the dollar. It's not really a revaluation from the central bank. And the capital control is not loosening. And we can see that yuan in the long term will have to be reevaluated precisely because China's relations with its trading partners, besides the U.S., is more important. A stronger yuan would make it easier for China to make a case to export more to those countries.
Dan, hold that thought. We'll have more from Dan Wang there, China Director at Eurasia Group. We'll have more on the eco outlook for China and beyond with BNP Paribas this next hour as well. Plus, Moody's Ratings is going to join us live to discuss their report on China's corporate outlook for 2026. This is Bloomberg.
All right, welcome back. We got to talk about oil, Venezuela, the short and the extremely long-term conversation that we need to have there. If, in fact, we do get to realize, I'm sure you've all heard about it, the world's biggest oil reserves, it's reserves until you're able to pump it out of the ground. It's reserves only, right? And a lot of capex, decades-long commitments. In fact, you have big oil. We understand nearly 20 oil executives are slated to meet President Trump and top officials at a White House. That's later on Friday. That's as the Trump team pushes them to help rebuild the battered energy sector in Venezuela. Let's bring in Stephen Stapczynski, who leads our Asia energy coverage, who joins us from Singapore. And, on paper, it already looks very difficult, expensive, and a lot of patience is needed here. Stephen, but just underscore how massive of an undertaking this will be and whether or not big oil will be behind this.
All right, let's focus on how massive this is. So Venezuela produces about 800,000 barrels per day of oil. In the early 2000s, it was 3 million. In the 70s, it was 4 million. So there's a lot of potential to go back, but over the last 2 decades, there's been a lack of investment, there's been corruption, and their infrastructure has really deteriorated. Pipes aren't working like they're supposed to be working, rigs have been pulled off, and so this does require big investment to get back to that 3 million per day barrels per day of production that they had about 20 years ago. Analysts have forecast that could take about $10 billion per year for a decade to accomplish. It could just take billions of dollars to keep production where they are at the moment. So you're looking at something that's going to require a lot of money and deep pockets. That brings in big oil. That's why Trump is having this big party. Maybe he'll serve McDonald's. We don't know what's going to happen there. But they're definitely going to talk oil, and they're going to talk investment within the country. And I think the big thing in focus is trying to get American companies to put dollar investments into the country to build their infrastructure back up. Because if you don't have that, they can't pump more. And that's one thing that Trump has really kind of highlighted, is that this is a prize. It's an oil prize that they can use, share the profits with the local government, but it's something that they could help. And Trump wants oil prices to be down to $50. You know, we're around $60 right now, high $50 for WTI. He wants us down to $50. He wants to bring down inflation. He wants lower prices at the pump. But it's very unclear what's going to be agreed upon, which is why this Friday meeting is going to be in focus. Is the Trump administration going to offer potentially maybe subsidies? Or is it going to offer guarantees? Because if you're an executive at Exxon or Chevron and you're looking at the situation, why invest money in a country that maybe geopolitically could be challenging? Maybe if the next administration, the relations could quickly sour. You don't know what's going to happen in the long term. Whereas you have investments in shale fields in the United States that maybe are more of a sure bet. And then lastly, why invest now when oil prices are already so low? We're at the lowest level in years. Why do that? Is this a period where maybe you take your foot off the gas for new investment or new massive investment? So all of those things are swirling around this meeting that's coming to head at the end of the week.
Yeah, I think you laid out quite well, Stephen. I think and what your team has really written about in terms of sourcing from some of these big oil companies is that there seems to still be a massive gap between the vision and what it takes to meet reality. And I think at this point, a lot of people are unwilling to say no as well to the president, given that sort of ambition. Stephen, thank you so much for kind of highlighting what's at stake here at this meeting today. He leads our Asia energy coverage in Singapore as well. And the U.S. move to really strong arm Venezuela also threatens to open up new flashpoints with China. Let's bring back Dan Wang, China director at the Eurasia Group. She's still with us here as well. I think one of the things that really has, driven, the U.S. to seize Venezuela in some ways is the fact that we have seen China and its influence into Latin America and the Western Hemisphere. Do you see China in any way responding in a big way to what we've seen in the last few days?
In terms of commitment beyond verbal condemnation, I don't see more of a comeback from China. It has been quite conservative when it comes to more investment commitment or military commitment in the Latin American region, especially when it comes to Venezuela. It represents one of those sunk cost relationships that China has committed a long time ago to invest in infrastructure. But when it comes to political influence during the years, under the U.S. pressure, China has made very little inroad.
Okay, well, it could well be, let me just rephrase it could well be a sunk cost specifically on Venezuela. Let me just use an accounting concept. It still is an ongoing concern as it pertains to China's influence in Latin America. How does it change that broader strategy then?
Well, China's Latin American strategy is a quite important node of its Belt and Road Initiative. But in the past decade, we can see that the public financed projects has been steadily declining, but the private interest remains. We have seen a lot of Chinese companies investing in Latin America. So if we're talking about influence of sphere of the economic perspective, China has pretty high impact on the region. But politically, militarily, or in other initiatives, China is really lagging behind. But one positive improvement I've seen significantly in the past few years is in terms of the monetary cooperation. And in last December, President Xi Jinping came out to talk about its Latin America strategy in its policy paper. And there, at the center of it, it's about deepening the financial collaboration and the monetary collaboration. And that means China's RMB internationalization in Latin America will deepen. And the trade settlement will have more of a market, especially when it comes to the countries under sanctions from the U.S.
Yeah, when you talk about these spheres of influence, right, this quote-unquote Monroe doctrine that the president has named it of the U.S. has the authority to assert control over Latin America and to actually reject outside countries from getting involved. What do you think that how China looks at that right now? I mean, does that give any sort of move for China to claim East Asia, for example? The implications for Taiwan, do you think that there are any, and are they valid?
The Latin America is not really a playbook for China's strategy on Taiwan. And China is quite pragmatic when it comes to this sphere of influence concept. If similar situation like Venezuela operation happened in Asia, China would have responded way more forcefully than what it did after this incident. We have to acknowledge that the cost of control, economically or politically, increase exponentially with distance. And South America, it cannot be further from China anywhere on Earth. But for Asian region, it is really the sphere of influence for China. Even if we don't fully agree with the whole concept, China has more of an economic impact rather than political impact for any of those countries. But nonetheless, the political and economic coercion is more likely when it comes to Taiwan. And we can see that the China hawks after the Venezuela operation has toned down significantly as well, because the popular narrative before was that the East is rising, the West is declining. But now it seems that all of a sudden people all realize that America has the military might to just deter whatever China wants to do to Taiwan if they really want to.
Yeah, but hasn't China taken advantage of this opportunity to, well, largely, and we've had an interview this week that talks about that, to discredit the United States for, at least in this specific case, its disregard for sovereignty?
The international law certainly is not binding for big powers like the U.S. So China could take advantage of that. But when it comes to practical measures against Taiwan, it probably will be more realistic for China to use economic coercion, more of a sanction for Taiwanese companies, or more restrictions on the shipping routes. But for a military attack, it is very much a last resort decision. Because if China really decides to do this, it has to make sure that it's a quick, decisive win. It has to make sure that it doesn't turn into this wicked situation like Gaza or a prolonged war like Ukraine and Russia. Because after that, the perceived military credibility of China will be badly damaged if it's not really a quick win.
Just a theoretical exercise. Let's assume for a moment that this did not happen, Venezuela, this year. Does it in any way affect, how does it change, if any at all, China's foreign policy priorities this year? And what would those be, agnostic of whether or not this thing happened or not?
Well, we just published our top risks for the year. Actually, the China-U.S. relation and the Taiwan issue are not among the top risks. They're just red herrings. And China will do everything in their power to make sure that this year the China-U.S. relation will have this stable environment, especially before the April Trump visit to China, and also later in the year, President Xi will reciprocate and visit Washington. So this is quite a diplomatic year. And for China, the priority is really to take this time as a breathing room to fix some of the domestic vulnerabilities. And domestic economy is certainly one of them, but mostly it's about the neighborhood environment. China has been engaging quite heavily with its neighbors, the ASEAN countries, the Korean development we can see is quite positive. The bilateral relation with Japan has been in a very risky stage. And there is no way that China is going to back out in its current position. So it has to engage as much as possible with the rest of Asia.
Dan Wang, thank you so much. Happy New Year. We'll speak again. China Director there at the Eurasia Group, joining us out of Singapore. If you're one of our viewers and clients, you can rewatch that specific interview we just did there with Eurasia. Check it out. TV Go is a function that you run, and be part of the conversations here. We have a few more coming up here on shows, one on global economics, one on corporates and financial and fiscal, net gearing, that sort of thing, ratings and financial health across corporate China. So if you want to be part of this conversation, do, of course, chime in using the TV Go function. This is Bloomberg. Right, a very quick glance at markets. Rio Tinto is one to watch very closely here. So, yeah, Glencore talks, merger, world's biggest miner, in focus. We're down at 6%. The biggest drag on the benchmark today certainly helps that fact that it is a very heavily weighted stock as well. Right, a lot of listings here in Hong Kong. You have 3, and they're doing well. In fact, we've crossed the 50 handle on MiniMax. We're now up 54%. So stay tuned, of course, for our interview coming up there. With MiniMax, it's Steve, of course. What are they going to do with the money? Gen AI, that's a conversation worth having, not just today, but beyond. 2 other listings are doing substantially well. And the geopolitical overlay is still playing out across these defense-related stocks across the Asia-Pacific. Plenty more ahead. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI half hour into the session, and we've bounced off some of the lows here right now. So you are seeing a little bit more momentum coming back in this market, but most of the region is actually seeing a bit of retreat once again here, just given what we're expected here, the U.S. payrolls number. You have a possible Supreme Court ruling on President Trump's tariffs and whether they are going to be deemed illegal or not. So there was initially this rotation out of tech shares, but in Asia, or at least I should say in China, it's quite the opposite, actually, when you take a look at some of these big names.
It really is. In fact, the Nvidia story helps on the margin, right? So at least now, if you think about it, this is a very simplistic way of looking at it. Now they have options as it pertains to 2 generations behind in chips. Alibaba's up about 4%. And of course, just to be clear, that's still a could, right? It could happen as early as this quarter, and that will depend, of course, on who gets access to what specifically. Hang Seng Index, stay tuned for this. So we've actually run the numbers, and it's plausible that the Hang Seng Index could actually see a fresh record this year. We'll lay out those numbers for you later on in the show. LG Electronics out with some numbers that have come through so far. 4Q operating loss, 109 billion won. The estimate was for a profit. Market is reacting adversely, as you can see on your screens. Very quickly, Hong Kong listings has continued to be a top story. It's been extremely busy, and we're only in the first week, right? 56% trading debut of MiniMax, and the other 2, of course, are also doing substantially well in their first day of trade. If you're tech, if you're biotech, if you're a combination between the 2, if you're robotics, it's certainly been a very good time to list. Price up, realize your value, and then the secondary market also gets their dip. So why not?
Yep, certainly has been a good one, especially when it comes to MiniMax as well. Let's get to, of course, the Hong Kong Exchange. Our chief North Asia correspondent, Stephen Ingle, is standing by there with, of course, our exclusive guest, Steve.
Yeah, that's right. It's MiniMax's co-founder and chief operating officer, Yeyi Yun. Thanks so much for joining us exclusively here at the Hong Kong Exchange on the debut of MiniMax, stock code 100. Very symbolic as well, because I know the founder is essentially a ones and zeros, the binary code of mathematics, right? So congratulations, first and foremost. How do you feel? Because you did price this listing at the high end of the range. It had high demand, 1,800 times oversubscribed retail tranche, 70 times oversubscribed on the institutional tranche, and now we're seeing a 58% pop up. Is this a vindication of your plan going forward?
So I think our group feel excited today, but it's also just a normal day. We will invest all the resources to achieve our mission we set up from day one, which is intelligence with everyone. Also, it's our understanding about AGI. So what's intelligence? We want to bring the world-class technology foundation models to all the world. So in the past almost 4 years, every single year we make technology breakthroughs. We deliver world-class models in each modality to the world. And what's with intelligence? So we hope all the world users, the enterprise could use our models. So currently we are serving around 200 million users across all the world. and more than 100K enterprise customers from more than 100 countries are using our model.
So how do you scale your multimodal capabilities without being profitable and without having a large capital base, unlike an OpenAI or Anthropic and others? You're a open source, lower capital model. How do you scale those multimodal capabilities, not only in China, but abroad as well?
I think I have been working in AI for around like 10 years. I think the beauty of foundation model is like general purpose use model. So you make one model and different kinds of use cases, no matter if users or enterprise customers, you are using your models. So we put most of the resources on the models. If the users, they think your model have the best performance in their use cases, they just directly use it. As you said, so in the past, around like 4 years, we really focus on the capital efficiency, cost efficiency. So we had only spent around 500 million USD in total, probably only 1 or 2% of the big giants spending. So we did all the optimization, made innovations on it. Yeah.
How do you compete though, if you're going to go global? How do you compete with an OpenAI or others that are throwing lots of capital at their business? Is it viable, and what is the technology gap looking like in the next few years?
Actually, I don't think it's a competition. It's more about all the top talents across all over the world. They bring the technology breakthrough to the society, to the end users. So you will see each models have pros and cons. So we focus more resources on building the models, building the best product experience to let more and more users from all over the world to use it.
Now, your proceeds have been stated are going to be used for research and development for other models over the next 5 years or so. What are going to be your chip needs? We know that there's a bifurcation in the chip world. We're hearing as well the Chinese government might approve Nvidia's H200 for China in this quarter, perhaps. Is that something you need to look at, importing more advanced accelerators for your training and the like?
I think in every industry with a really high growth, so when the new technology comes here, so you will see every startups, all the companies, they face resources constraint. Probably chip constraint, computing constraint is only one of the challenges. So in the past, you will see our model performers and our product performers. So our resources is stable, we can get access to all of them. So we focus more on our R&D and foundation model. So we just use whatever chips could make sense for us at that specific stage.
Is your goal to stay indigenously with your chips, locally made chips, or would you buy Nvidia chips as well?
Actually, we have a really high capital efficiency, and we really focus on cost efficiency. So it doesn't matter what kinds of chips it is. It's more about which chips can give us best ROI, which can help us to achieve our mission to make the best technology to accessible to all of the users across the world.
So when does the emphasis turn from efficiency to profitability, and also getting that steady revenue growth that will then justify a higher stock price valuation?
So we put lots of R&D resources and innovations on the efficiency part. You will see our API, we have an enterprise business, you will see the gross profit margin of our API is more than 65%, which is probably already one of the highest globally. So we focus more on make the best technology and the best user experience. People will love to pay for the best performers models for their use cases.
Now, speaking of the different models, and you have multi-model capabilities, you've also come out of a price war, essentially, a race to the bottom, some have called, because of you're trying to keep costs down and you want to survive as well. There was a battle of survival, and you have been one of the survivors. But at the same time, the startups are not the only ones. The big players, Alibaba, ByteDance, Tencent, and others. How do you compete with them at a low-cost basis?
Actually, it's not. I don't think that's a price war. It's more about the performance competition. So you need to make your model best, and the people, end user or enterprise customers, they don't choose your model because of it's cheap or expensive. It's more about its performance. So that's the key. As you said, I think it's not about the competition between all these big giants, but it's more about some of them, they are like our cloud providers, and some of their products, they are using our models. So it's more about the collaborations. All these companies bring the foundation models to all the world.
So where are going to be your more feasible areas to expand abroad? Because again, going overseas is going to be a big challenge, isn't it?
Actually, we set our strategy going global, grow up global from day one. I studied in the US, I had been working there, I'm working here right now. So I think the beauty of foundation model is just to build one model all over the world in different languages. They just use this model. Yeah, the same model. So focus on your model, focus on your product. It's the key. Yeah, there is no boundaries among different regions.
Okay, Yeyi, thanks so much.
Thank you.
And congratulations and happy birthday as well.
Oh, thank you.
Going to send it back to you from the Hong Kong Stock Exchange, where we saw a fairly successful debut of MiniMax, stock code 100 here in Hong Kong.
Yeah.
What a birthday.
What a birthday. It's quite rare that someone gets the opportunity to bang a gong for their birthday. But yeah, there we go. Fantastic. Steve.
Go party, yeah.
Yeah, go. It's Friday anyway. Pints on me. Pints of water. Okay. Coming up, we'll be talking all things macroeconomics here. So what is the state of the global economy given quite, I wouldn't say very extreme, but quite distinct possibilities as it pertains to U.S. rates, U.S. growth, and the tariff conversation given the risk of the Supreme Court, possible risk of the Supreme Court today. All that will be coming up. Conversation with BNP's chief economist. This is The China Show.
I'm unsurprisingly the lowest dot. I'm looking for about 1.5 points of cuts. A lot of that is driven by my view of inflation. I gave a speech about this about a month ago in December at Columbia University. My view is that almost all of the excess inflation over target is due to quirks of how we calculate inflation.
Yeah, Stephen Myron there, of course, joining our colleagues in New York exclusively, and the case he's making is, even if you cut interest rates, that doesn't risk unwanted inflation. 1 million Americans are out of jobs. We can put them to work without fueling inflation. Really, one of the things, jobs data is coming out today, among the many other things, including this potential ruling from the U.S. Supreme Court on tariffs, which is possibly, let's see how they do it, and if they do it, possibly it could be very, very consequential.
Yeah, Bloomberg Economics has been kind of crunching the numbers on really what could be at stake here, and they put this price tag at $150 billion, David, right? If you calculate all the sort of tariff revenue they've accumulated up until maybe January 9th, and that makes up, get this, 3/4 of basically President Trump's trade policies. So it's quite a lot in terms of what could happen to potentially what this means for, of course, the trade agenda. So if we see actually a negative ruling, this is what we could see in terms of the refunds. That's why you've been seeing hundreds, if not more than 1,000 companies that have basically now filed for lawsuits to try to get a chunk of this if, in fact, it favors against the Trump administration and deems these tariffs, which is under that International Emergency Economic Power Act, as illegal. So certainly that's what's at stake here this morning, and certainly what we're focusing on the next few days is how will this all be refunded, right? Is it going to be up to the Supreme Court? Maybe not so much, right? It could be that decision leads to the lower courts to decide how the money is going to be divided, who gets what refunds, and how this whole process is going to work. But the poly markets, if you look at how the prediction markets are looking at right now, they're actually thinking that there's quite a bit of a high chance that the Supreme Court is going to vote against the Trump administration. You put the odds now for a win for President Trump at only about 25%. You've seen that in other sort of prediction markets as well. BE puts it at around 60% that we could see a negative ruling. So it's not, it seems like there's, in terms of the trade experts, there is a high chance this could be something that goes against the Trump administration. So lots in terms of what this could mean, right? It potentially could put the effective tariff rates from the U.S., Dave, from 14% I should say, to 6.5%. But they're saying it might not last that long because, the Trump administration might be swift in replacing some of these tariffs to other more legal sort of provisions as well. So that could still be something that they say the economic relief might not actually last that long, Dave.
Yeah, it might not be quick enough to process the refunds, and then we'll get the number back there. But, I mean, anytime you give a whiff to anybody that there's some money to be had, you'll have people raising their hands from the front row all the way to the back. Joining us here to talk us through the potential implication of that on growth, the U.S. and abroad, currencies and everything in between. Here on set with us is Isabelle Mateos, Lago, Chief Economist at BNP Paribas. Good morning and very nice to see you. Happy New Year.
Good morning. Happy New Year to you too.
First, we don't know if the U.S. Supreme Court will in fact give a ruling. If they do give one and it's adverse to President Trump's agenda, how do I need to be thinking about that whole new scenarios that open up?
Well, first of all, I'd like to say it's astonishing how we keep referring to polymarket as a way to guess what's going to happen to markets. It didn't used to be that way. We used to look at macro data, see what the modeling says. No, now most events, we only have polymarket. So anyway, it's one of those. So it's obviously a very important decision. What I'm looking at is more the potential macro impact, and I think that's what markets are going to be looking at. As you've stated, even if the Supreme Court were to decide or rule that the legal basis that was used by President Trump to roll out these tariffs was not the right one, there are others that can be used. But the question is, indeed, does the Trump administration end up having to give out a lot of refunds? It's not a done deal because these legal decisions are rarely black and white, and so the Supreme Court could find a way to say, well, if there was an emergency, it was okay, but an emergency is not something that's open-ended, and so beyond a certain date, so there is a way for the Supreme Court to not validate the whole thing without necessarily opening a base for refund. We'll see, but it's clear that if we end up in a situation where hundreds of billions of dollars or that order of magnitude of revenue that was counted on all of a sudden isn't here, that changes the macro pictures. And assuming there's not going to be any offset because we're in an electoral year, all of a sudden you have the prospect of an outright stimulative fiscal policy. And I think markets will look at that, bond markets will look at that, the Fed will look at that, because that can also change the situation in terms of inflationary pressures and relieving worries about the labor market. So it's actually a really big deal. But we're not going to know right away because the Supreme Court will say what it thinks is right, and then the administration will have a choice of how much to try and replace the tariff revenue if it's gone. Let's also not forget that President Trump seems now to realize that the tariffs feed into the affordability issues that he's trying to fight. So he may also decide to deliberately not replace all the tariffs that have been invalidated.
And you mentioned in your report 2025 was more like the dog that barked that had no bite, right? Mm-hmm. All these kind of fears of Liberation Day and tariff-induced inflation never played out as feared. Could that play out in 2026, you think, or do you think it's still going to be more bark than bite?
So I think the tariffs probably did have an impact, but then there were a lot of offsets.
Yes.
And I do think 2026 could play out in a similar way. We'll have shocks, and there will be offsetting shocks, and at the end of the day, the macro will be okay. But let's remember 2025. The numbers at the end of the year all look fine, but there were lots of ups and downs along the way, and I think we may see something fairly similar in 26.
So what assumptions are you making on the U.S. economy as things stand? So will growth be better or worse, and will rates be higher or lower?
Right. So we're seeing the U.S. economy in a pretty solid shape, with average growth in 2025 at just under 2%, and we see this continuing into 2026, hopefully with less ups and downs along the way. In that situation, we see the Fed cutting one more time around March.
Just once.
But because, again, we're not particularly concerned about the labor market, we are aware of this low hire, low fire environment, but as things stand, there is no need to be particularly worried. And in fact, inflation is going to keep accelerating for a bit before it settles back down. So in fact, we see inflation for 2025 at around 3% on average, 26, similar to 2025. So that's not a context in which the Fed really will have a lot of leeway to deliver multiple rate cuts.
When you mentioned some of the offsets that we saw to the tariff sort of hits that we saw to the global economy, was AI, I guess you're assuming. Yeah. I mean, whether it was AI investments to even just asset prices to even just exports, I think AI has been a dominant theme. How long can that continue, do you think? Or do you think that we'll start to see the optimism fade pretty soon?
I'm not sure. I mean, it's still, this is clearly a life-changing, world-changing new technology, and it seems to me we're still in the early innings of developments of adoption and of corporates understanding what they can do with it. So it may be that there will be phases where the optimism wanes a bit or wavers, because right now there's really lofty expectations in terms of the earnings and the profits that can be generated from this. I think we're also beginning to see a subtle shift from, we call it AI, but in reality you have the chips part, then you have the LLM part, and then increasingly you have people saying, well, actually the biggest bang for the buck is not going to be from LLM, that's just, productivity enhancing stuff, but if you want to generate value, revolutionize manufacturing, this is a completely different set of tools. And of course, it's not the same companies involved at every stage of the process. So it's possible that we're going to see a morphing of the optimism in this whole space of AI. Now, if you're manufacturing chips, chances are you're still going to be okay, because no matter what is the main application, you're still going to need the chips. But if you're providing a particular form of AI service, then there may be waning expectations of profits in one area and more in another.
That seems to be a strong, taking in everything together, that seems to be a strong case for the U.S. economy. How do you think about everything else outside the U.S.? For people trying to figure out, will U.S. exceptionalism come back? And do I fade last year's rally on everything outperforming the U.S.?
So it should be a somewhat more nuanced story. Having said that, we remain very bullish about Europe. Okay. And in fact, we see the growth differential between Europe and the U.S. shrinking further. So you still probably have U.S. come out on top, but we've been bullish about Europe throughout 2025. We were pretty much alone in that camp, but we've been proven right by the data. And frankly, we see this continuing, and the latest data coming out, frankly, in the last 3 months already from all across Europe, including more recently in Germany. Things are shaping up for a very solid 2026. Powered by the German investment, but of course percolating through the entire eurozone, and all the indicators are going in the right direction. ECB doesn't need to do anything else for the time being. It can sit back and watch inflation stay close to its target and growth pick up.
I was going to ask you about just geopolitics before you go, about the change in world order and what we're seeing with Venezuela. Do you see any sort of disruptions economically, or at least for supply chains around the world, especially when it comes to oil?
Yes, so I'm not sure we can talk of world order anymore. I think the order bit is probably gone for the time being, and this is going to be a more shock-prone environment, geopolitically speaking. I think this is inevitable. I think, by the way, the natural response to that is for everybody to invest more in their own defense, which does have both macro and micro implications. But once you've said all that, the reality is most geopolitical shocks don't really have a lasting market or macro impact unless they touch on critical global supply chains, and oil in particular is very important. Any shock that doesn't impact oil or some other critical supply, I would think, probably not a big deal. But we need to be prepared for many more shocks, I think, this year.
Isabelle, it's great to have you. Isabelle Mateos,
Thank you.
Lago there, Chief Economist at BNP Paribas. We got plenty more ahead. This is Bloomberg. Some movers that we're watching, of course, are some of the oil plays this morning, just given some of the bump up that we saw in oil prices as well. Of course, we're counting down to that big meeting between some of the oil execs with the Trump administration when it comes to what to do in Venezuela. The message from the president seems to be, do this for your country. So we are seeing, of course, oil majors and the like doing quite well here in the Asia session. Santos is up about some 3% or more. This is Bloomberg. 11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break in just a minute or so. And there you go. We are seeing a bit of a rally there underway when it comes to equities. I think fast retailing has a lot to do with what we're seeing there. And really, given what their update on their revenue guidance, that certainly did lift the stock as well, lifting Japan today. Nikkei 225 up more than 1% here right now. Yen is a little bit on weaker. We're now above 157 levels here as well. And JGBs are selling off just slightly here this morning.
Yeah, Uniqlo. That's really more my vibe.
It's cold, you know. Everyone's talking about puffy jackets.
Yes, down. Goose feather down jacket. Right, sorry. Okay, it's very rare that I would agree with ski jackets, right? But I think today is one of those days where. But give me one. Okay. Speaking of something that's not too hot but not too cold. Inflation numbers coming out of China, right? So slight pickup, in line with estimates. The PPI is also coming in not as deep a contraction as the prior month. And it certainly helps that you have, I think, 4 months down of commodity prices moving up. So that might move the needle on PPI. CPI, though, remains more of food, transport, and demand equation there. But yes, in China, inflation hits 34-month high. There we go. This is a rebound by food prices. Thank you so much for that statistic. Now, as China navigates this deflationary pressures and how to get around that and push back on that, Moody's rating says Chinese non-financial companies should be cushioned by the tech-driven revenue and proactive debt reduction on the corporate side specifically, according to that report. Joining us here in set is Lina, Choi, Associate Managing Director at Moody's Ratings. Happy New Year and good morning.
Happy New Year. Thank you for having me again.
So what I just read there sounded maybe like Greek and a bit complicated. So let me just, in summary, things are stable.
Yes, and let me try to unpack that a bit more for you. Yes, the credit conditions outlook for non-financial corporates is stable, and it's supported and anchored by 3 key factors. First is, as you correctly pointed out, technology upgrades and innovation are already helping technology-related sector companies to post higher than expected revenue growth, and also on the cost line, also help them to optimize their efficiency as well. So that's driver number 1. Driver number 2 is the government policies supporting higher productivity sectors and trying to encourage Chinese companies to rationalize competition. You know, the most recently introduced anti-involution measures trying to restore industry margins and create more sustainable growth. So that's driver number 2. And last but not least, of course, comes back to financial discipline of rated companies. Just to give you a sense, we do expect debt reduction for the rated portfolio of companies. We are expecting that total debt of rated companies will be reduced by about 5%.
This is absolute value or net gearing, generally speaking?
This is absolute value, absolute quantum of rated debt.
Okay.
Yeah.
Just to clarify.
It seems like there's a lot of these tech companies in particular that are heading into like dim sum markets and the like to really kind of raise money. And are we likely to see more issuance on that front this year then?
Yeah, this is definitely a trend, Yvonne, that you correctly pointed out that we have observed starting second quarter of last year, really. And that's a measure of a lot of the POEs in particular, trying to broaden further their funding access. And a lot of these issuance that we have seen are from highly rated companies. And for the interest rate difference, that obviously would be a more cost-effective way for them to broaden their funding channel. And yes, we do expect more to come probably this year.
Outside of tech, how is the rest of the group doing?
Yeah, this is where the balancing factor comes in. As I said, the technology-related companies, companies in internet services, in high-end manufacturing, and in smart appliances, for example, the aggregate rated portfolio revenue growth we forecast for this year is 8%, which is very high. Okay. But the overall revenue growth, however, would be just in the 4%. So what that tells you is the more traditional sectors, property-related sectors, the more, FMCG part, probably are having much lower to slightly decline in revenue growth.
Okay.
So it's a bit of a mix.
How are you looking at the property space? It seems like we've seen more new risks that have kind of played out or re-emerged risks in the property sector. Given what we've seen in Wang and the like, what are you assuming here right now in terms of what creditors can really get back, the recovery rates and the like?
Yes, indeed. The recent credit risk events in the China property developer area really didn't help for a sector that has been in the doldrums and trying to find a bottom for a couple of years now. What we are concerned is this is going to prolong the weakness that we have seen for a while. We are forecasting, our property forecast is contracted sales this year is going to continue declining. Although on a very low base now, probably the rate of decline is going to narrow a little bit, but these credit events probably are going to get home buyers less confident and worry about completion rate. That definitely will not help the contracted sales. More importantly, investor concern are going to be reignited again, and that's going to further constrain the already tight funding access for these, private, weak liquidity property developer. Just to give you a sense, maturity wall is still quite big.
Yeah.
In the rated portfolio, the rated portfolio maturity wall this year is still in the order of $10 billion. That's quite significant. So, on and off, we have seen the government put out, some measures, mostly along the lines of relaxing home purchase restrictions.
Yeah.
And unfortunately, the credit events are probably just going to impair the effectiveness.
Now, if we take out the industry or sector sort of diagnostic and just look at between SOEs and POEs, what's the main difference you see, and how does that trend this year?
It's a little bit uneven, to be honest, David. When I think about it, look, SOEs have always stood quite firm. Because their funding access, their government or local government relationship, from the domestic funding channel, banks support, for example, they have been always having an advantage over POEs. Now, but if you look at POEs, again, the high yield part and the investment grade part are also different, because the rated portfolio features POEs that are mostly market leaders. For example, the internet services companies, and with the government's new focus on encouraging higher productivity sectors, technology innovation and whatnot, these highly rated and rich, solid balance sheet POEs, they do have a role to play. They will have to invest more, but their balance sheet remain quite bit of a buffer room to support that kind of growth.
Yeah, just looking at some of the ratings actions that you did last year, I think in terms of investment grade, you made more upgrades than downgrades. High yield, maybe a bit more downgrades than upgrades. But what's the outlook for 2026 right now? Do you foresee things looking better, or do you think we could see more downgrades?
Yeah, if you look at the key drivers of our stable outlook, I would think that on the technology-related side, we are expecting higher revenue growth and stable margin. That's because these technology companies are already seeing partially the benefits of innovations and technology upgrades. Either they have broadened revenue sources, or on the cost side, they do have more levers to push, if you would, to shore up the margins and make them more competitive.
Final question, I just thought about it. It's been a really hot equity market, capital raising. That's a new funding source that perhaps has become now more realistic for a broader set of companies. Does that affect how you look at financial health and the ability to raise money, not just in debt, not just in banks, but the equity market now seems to be a feasible option for even smaller cap companies in Hong Kong and in mainland China?
Yeah, of course. Equity fundraising is definitely one of the very viable and helpful funding channel or funding access that we consider for all rated companies. And, we did see, large companies, technology related, NEV related company coming back to Hong Kong last year, for listing. So I think if that trend were to continue, definitely that will be helpful for the funding access.
Lina, good to have you. Lina Choi there, Associate Managing Director at Moody's Ratings.
Yeah. Okay. Rio Tinto resuming talks, of course, to buy Glencore, creating the world's biggest company. Let's have a look at that. 6% to the downside. Martin Ritchie is with us in Shanghai to talk us through this. Martin, so we're here again. We're here again. So the talks have resumed, but is it going to go through this time? Is the question.
Yeah, that's right. We have been here again. Back in 2014, the two companies, Rio Tinto and Glencore, did talk to each other about a combination. This would be a very big deal in the mining space, the biggest ever, and we've talked a lot about the biggest ever deals potentially in mining over the past year, but this would be it. The two companies' market cap combined is more than 200 billion. But as with some of the other deals in this space, there's a lot of sort of complications for this one in particular. We've got Glencore is one of the world's biggest producers of coal. Rio has already exited coal and doesn't particularly want to go back into coal, so that's something they would have to deal with. Rio Tinto has a dual listing structure, which might complicate the deal. The two companies are, a lot of people point out, they have certainly in the past had very different cultures. Glencore being very aggressive, personality-led culture. Rio a little bit more on the corporate side. Don't know how much that is true nowadays. And then Rio's got a major Chinese shareholder, Chinalco, whose opinion will have to be sounded out on this deal. And then antitrust would be an issue as well. It would create one of the world's biggest copper producers in particular. And that might have implications on the regulatory side, getting approvals from the likes of China and other major customers.
Yeah, there seems like there's still a few gaps there, as you mentioned, not just when it comes to the culture. The valuation of the deal itself last time around seemed to be where the two sides failed to agree upon. So what still needs to be ironed out, do you think, for this deal to actually go through?
It's about the structure and who gets what and in terms of the post sort of restructure shareholding. I think there's still a lot to be kind of sorted out and in a relatively short time frame. So Rio has to, according to the UK rules, Rio has to submit a bid by February the 5th, although that could be subject to delays. It's going to take a lot of talks in the meantime, and we're going to be canvassing, other companies that might have potential interest as well. Talking about potential interlopers, BHP is an obvious one that would be thinking about here.
Martin, thank you. Martin Ritchie there, our metals and mining reporter, joining us out of Shanghai. At Rio Tinto shares still lower here this morning. This is Bloomberg. Some stories that we're tracking for you today. Venezuela's government says it plans to free some local and foreign prisoners after the U.S. capture of President Nicolas Maduro. The National Assembly leader announced the plan on state television, describing it as a peace gesture. It is not clear how many prisoners would be released. Spain says 5 of its citizens are among those to be freed. Reliance Industries says it will consider buying Venezuelan oil, but is still awaiting clarity on whether non-U.S. buyers will have access. Reliance has been India's top buyer of Venezuelan crude, and sources say Reliance is among major oil firms invited to meet President Trump as the administration pushes to rebuild Venezuela's energy sector. White House trade advisor Peter Navarro says U.S. industrial breakthroughs will eliminate China's market dominance in rare earths. Beijing's efforts to withhold supplies of critical minerals last year helped fuel a trade war with the U.S., but Navarro told us that American innovation will boost domestic production.
The China relationship is a very difficult one. China has been flexing its muscles now in Europe, in India, in the United States, saying basically, we're going to do what we want, and if you try to stop us, we're going to take away your critical minerals, because they think they have a monopoly on it. But that's just a matter of time. American innovation is going to quickly wipe away that innovation, that threat, that weaponization.
And you can listen to that full conversation between Michelle Hussein and Peter Navarro by searching The Michelle Hussein Show wherever you get your podcasts.
Yeah, fairly straightforward search there. Deputy Prime Minister of Cambodia says that the country wants to lower the temperature in its dispute with Thailand to protect its fragile ceasefire. Speaking exclusively to Bloomberg, Sun Chantol says also pushed back really against Bangkok's assertions that the clash was part of a battle against scam centers operating across the border.
Well, the ceasefire is still fragile, but I want to reassure you that Cambodia committed to the ceasefire. Cambodia needs peace, and I'm sure Thailand also needs peace in order to build our country, our respective country, for the benefit of our respective citizens. So we are committed to resolve the conflict through a peaceful means. We have different mechanisms in place. We have GBC, General Border Committee. We have JBC, Joint Boundary Commission. Cambodia and Thailand will be neighbors for next thousands of years. So let's work together to develop our economy for the benefit of our people, for the benefit of ASEAN. We cannot have a conflict or else we lose the credibility of ASEAN. So I hope and I wish that this conflict can be resolved peacefully, sooner rather than later. I'd like to take this opportunity also that we need to lower the temperature. The Cambodian citizen, also the Thai citizen, let the government work together to find a peaceful resolution. Do not add fuel to the fire.
Last year in April, Cambodia was among the top of the list of President Trump's tariff rates. It was very high, over 40%. You led the negotiations for Cambodia. The rate is now 19%, much lower. Now that a few months have gone by, I do wonder what has been the economic impact of those levies so far.
2 days after the announcement, our Prime Minister sent a letter to President Trump, offered to discuss, to negotiate in good faith the trade between Cambodia and the U.S. I believe that Cambodia was the first country that concluded a comprehensive reciprocal trade agreement between Cambodia and the U.S. Now, we are continue to discuss with USTR regarding certain sector that we believe should receive a lower reciprocal tariff. For example, the garment, the textile, the footwear, travel goods that employs nearly 1 million workers, predominantly women. So we ask USTR to reduce those important sectors for Cambodia for potentially reducing or zero out those sectors. It's important for Cambodia.
Yeah, important conversation there, of course, with the Deputy Prime Minister of Cambodia speaking with our colleague, of course, Philip Hyemans there. Right, if you're one of our subscribers, you can check that interview out, watch some of the others you might have missed here, of course, on Bloomberg TV. TV Go is the function that you run. Plenty more ahead. This is Bloomberg. Welcome back. You're watching the China Show. So we're taking a look at the outlook for the Hang Seng Index, right? So we've run the numbers, and if you look at it, it's very plausible that we actually take out, and by the end of this year, even before that, we could actually see the Hang Seng Index hit a fresh all-time high, right? So the distance to the peak in 2018 is at about 28%. The average gain during an up year, and we've had 25 of those years going back to 86, is about 27%. So if you think about it, and yes, I understand 80s, 90s are different, 2000s, but if we have an average up year, that gets us pretty much there to an all-time high, right? Now, when you look at the current projection, so we look at the actually bottom-up analysis, you take all the share price targets, consensus from all the analysts on Hang Seng Index stocks specifically, and you amalgamate that, it's a bottom-up approach, and you derive a specific number. That number is 31,300. So from about the current level, that's about 22% away. And that would be enough to take us, not quite to the all-time high, but enough to take us above the 2021 high. So we could end up, of course, at about an 8-year high, give or take, by the end of this year. We put that on a chart for you. That's where we are. That's the 2021 high. That's the 2018 high. There's the current projection. So we could get there, right? So all things equal, it's looking like we could get a good year, 22% on the Hang Seng Index.
Yeah. What was the number? 33,154. That was the actual 2018 record, right?
Yeah.
That we might also see. And what's the whole bet? You always have it on X, right? Whether you put on the Chewbacca costume or the
I put it out recently. So if we get above, okay, I'm going to get seated now. Okay, so if we get above,
you don't have to tell people.
No, okay, sorry. So if we manage to, okay, for the record, if we get to an all-time high,
yes,
at the end of the year, it's going to be a full-on Chewbacca costume, assuming my bosses allow it. Clearly, the other side of the trade is 20,000 and below. It's Care Bears because of the bear situation. And, we could use a Chewbacca costume now because it's quite cold. I mean, the fur could help.
I thought you were going to say Labubu or something. Keep it more like 2026,
We could come up with a mid-cycle June target and figure that one out.
I'll raise you.
Yeah.
Labubu for you. All right. Whatever you want to do. But make your bets. What you want David to end up wearing.
My bosses won't allow it, though.
We'll see if we can wear it on the show or not. We'll put it at least on social media. You can get an insider's guide to the money people shaking up the Finance Hub in our Hong Kong edition newsletter out every Thursday. David actually has been writing exactly about this very issue here about Hong Kong and the records that we could hit in this week's newsletter there. So check it out there. Subscribe at Bloomberg.com/newsletters.
We're closer to that because of the big gains we're seeing across the big stocks. Zijin Mining, Kuaishou, Alibaba are all up 3 to 4%. That's really on the back of the precious metals move. And, of course, also what we're seeing across the Nvidia, the developments, the potential developments, assuming, of course, that happens this quarter, plus everything else that's come out so far, right? It's been really this pivot into, within the AI space still favored, within, of course, some of the names there. And, of course, massive trading debuts today here as well, underscoring that bullish point.
Yeah, so I think the BE sort of reaction on the whole NVIDIA story is out. And they basically say that China's going to thread the needle, really, when it comes to NVIDIA's H200 access here. But the near-term benefits of this availability of this chip are significant, they say, and really can expand the pool, as you say, more choices of available computing power. And, allowing more actors to cross-train thresholds and scale inference across sectors. But that's why you're seeing why the tech sector is benefiting and at least reacting positive to that news as well. But that's it for us here. Bye.